Welcome to Wealth Matters, where we discuss the opportunities and challenges of preserving and managing wealth. This show is presented to you by Gaslowitz Frankel, a law firm dedicated to resolving disputes involving your wealth, whether through your will, your trust, your business, or your investments. For news, pictures, and tips, go to our website at gaslowitzfrankel.com or follow us on Twitter at Estate Dispute. Our show's hashtag is Wealth Matters. Your hosts today are Craig Frankel and Robert Port, and we're talking about behavioral finance, tips for overcoming irrational financial decisions.
And now it's time to introduce our guests. We are pleased to have with us today Jeff Bernier, President and Chief Investment Officer at TandemGrowth Financial Advisors, Andy Avra Wealth Advisors, and Taylor Stanfill at Recency Partners. Let me ask each of you first to tell our listeners a little bit about yourself, your background, and perhaps some of your certifications and qualifications. Jeff, let's start with you first.
Again, my name is Jeff Bernier. I'm the President and Chief Investment Officer of TandemGrowth Financial Advisors. We're an Atlanta-based fee-only wealth management company. We're focused on helping our clients create clarity and confidence to live a great life as they define it. I started in this industry on April Fool's Day, 1986. And so for 34 years, I've been helping people try to get their actions and resources in alignment with the goals and what matters most. I'm a certified financial planner professional, chartered financial consultant, have a master's degree in financial planning, and I'm a proud graduate of the University of Georgia.
Andy, how about yourself?
My name is Andy Avra. I started Avra Wealth Advisors 2.5 years ago. I'm a CFP, I have a CFP designation, and a CTFA, a Chartered Trust and Financial Advisor designation. Advisors focus on what's really most important to them. And so we provide life-centered financial planning for individuals. I have about 20 years of experience doing financial planning, have a master's degree in financial planning from Georgia State, undergrad at Georgia Tech, and have a wife and 2 young boys.
Right. And Taylor, tell us about yourself.
Yeah. Hey, thanks for having me. Taylor Stanfill. I'm a partner at Recency Partners. Been doing this about 10 years, although I don't look like it. And just love coming alongside families, individuals, business owners, and helping them figure out what's important to them, how to be intentional, not only in their family life, financial life, and just life in general. So kind of focus and specialize a little bit in retirement planning. And then on this topic as well, just have had a lot of folks give me feedback about behavioral finance and how that plays into things. And so love talking about it, and have 2 business partners, and we're big runners. So we run together a lot and get outside and kind of have that in common. So we have a good time while we also are very strategic.
Very good. So our topic today is behavioral finance, tips for overcoming irrational financial decisions. And all 3 of you have talked about how you approach your investment advisory in a holistic way. Let's talk a little bit about exactly how each of you define behavioral finance, because my sense is there's no particular definition, but it encompasses a broad scope of ideas. So Taylor, let's start with you.
Sure. When I think about it, I think our behavior and our decisions are driven by our beliefs. And so many times with clients, the first thing we do is, whether it's directly or indirectly, it's uncovering those underlying beliefs that are driving behavior. And whether those beliefs lead to good decisions, wise decisions, objective decisions, or lead to the opposite, non-objective, unwise decisions. So it's all those things that create or define behavioral finance for individuals, families, business owners.
And Andy, how about you? How do you either define behavioral finance or actually think about it in terms of your practice area?
I think for us, it's just understanding what people's tendencies are and their underlying biases are. Because I think everyone comes at it from a different approach. And there's some, whether it's emotional bias or cognitive bias, people make decisions based on certain factors. And it's really understanding what those factors are to help our clients live their best life and to make good decisions. And so every client is different. Every client has different past experiences. And so it's really uncovering what that is to help them avoid what we're going to talk about today, is avoid those irrational decisions and try to make them as rational as possible. given the fact that we are irrational people.
Jeff?
Yeah, I think what I would say is, as behavioral finance has become such a popular area of study in the last 50 years, there's a lot of detailed academic research on the different definitions of behavioral investing and behavioral finance. And I'm a lot less interested in all the fine points of the different definitions. What I'm really most interested in, how it impacts real people in their real lives, because at the end of the day, the way I view financial planning is just helping people get their actions and resources in alignment with what matters. And over a lifetime of investing, and investing is only one subset of that, I believe that investor behavior has more influence in the long-term success or failure of an investment strategy than the investments themselves. So I think investor behavior can have a huge impact if we can just keep from making the big mistakes. And at the same time, it's really, in my view, about return on life, not just about return on investment. So how can we create a joyful experience, not just an academically sound experience, but one where you can enjoy your life and not worry about the day-to-day things that you have no control over?
I've noticed in each of your answers that you've talked about looking at what motivates people. I think Jeff, you referred to it as biases. I'm sorry, Andy, as biases, and Taylor, you said as looking for someone's beliefs. Maybe it's I've been married too long, but I often find it hard to understand what my own biases are or what's motivating me, that I am sometimes oblivious to that. So as a financial planner, how do you help your clients identify what their bias may be or what their beliefs may be? Because it's kind of like saying, I like this piece of art, but why? So how do you, Taylor, how do you help your client identify that so you can get to understand your client?
Yeah, that's a great question. That is sometimes the hardest thing to do. It starts with asking great questions and a lot of questions. And just just continue to dig deeper and deeper, because the best thing you can do is help them identify their beliefs. And it's a lot of times, if you dig deep enough, if you ask enough questions, they start to have that aha moment of, oh, I get it. I feel, entitled. I feel like I've lived this whole way my whole life, or whatever it might be. They start to uncover these things, and it becomes a lighthearted discussion versus me telling them or saying anything. And so they're able to identify themselves as they begin to talk. And it's really, if they're married, it's great to have both of them together, because usually there's two different perspectives. And so, they know each other very well. And again, as you're asking questions to one spouse or the other, they start feeding off each other and really bouncing off and saying, oh yeah, I've seen that in you. And on the back end of that, on the other side of that, there has to be humility to embrace that. They can identify it and see it, but the next step is embracing it and that takes some humility to identify some of those beliefs, whether they're good or bad or false beliefs. It takes humility to embrace those.
Okay, Jeff, I'm going to put you on the spot. So you're the most experienced. That doesn't, just a different person. It's not an age thing. I'm probably older. But what's the first question you're going to ask a new client to try to figure out from the place from where they're coming?
Well, let me start, first of all, by congratulating you, Craig, on being human. You said that you had these biases and you had a hard time uncovering these biases. I think the first thing I would say before I answer your question is that we all have those biases. So your wealth manager is not immune to these same challenges that you face. So this is part of the human condition. But back to your particular question, I think the first question I typically ask is, why are you here? I mean, what are you hoping to find out, or what are the things that are keeping you up at night that you need to address? And so why are you here? But there are, at the end of the day, it's really about giving people a safe platform where they can be vulnerable. And the way to do that, I believe, is for us to be humble and vulnerable as well. And so you ask just open-ended questions about, if what keeps you up at night, what are the things that you're most excited about? If life turned out really great for you, what would that look like? And at the end of the day, just asking some really good open-ended questions and giving people permission to be themselves and not feel like they've got to put on, their armor, because we have armor. No one wants to admit that we have these biases. No one else wants to admit that we don't know things. I mean, that's part of the challenge as being behavioral investors as opposed to emotional investors, is that, we have to come to grips that there's just a lot we can't know. But what we can be experts on is how we feel. So I know this sounds a little soft for an academic environment and the things that we do professionally, but it's really just letting people have a safe platform to talk about their fears, the things they look forward to, the things that get them excited every day. And at the end of the discussion, these things will rise up, is my experience.
So, Jeff, you were just talking about biases, and my reading in this area suggests to me that, and this was a revelation to me, although when you hear it, it's entirely obvious, that a lot of what we're dealing with are things, frankly, dealing with our evolution over millions of years, the fight or flight experience, the fear of loss and things like that. So Andy, why don't you talk a little bit about sort of our natural biases, particularly with respect to financial decisions, and how you and your practice go about dealing with that.
Yeah, I think, I'm enjoying hearing what everybody else is saying as well. For us, from the emotional side, like, it really does come down to fear and greed as people make investment decisions. And, we tend to use software to uncover what people's tendencies are. And and so it's really just having those conversations with people to understand, where they're coming from.
All right. Well, let's talk about, again, I've gone through this, and there are lots of different categories, and a lot of these things run together. But I've tried to identify, for purposes of our discussion, various focuses of and things that the psychologists have pulled out. So let's talk about one in particular that has interested me, and that is the overconfidence we all have. And this dawned on me when I read about a study where they took a survey of drivers, and like 90% of drivers think they're they're better than average. And from what little I remember about college statistics, that can't possibly be. But that bleeds over into lots of things we do in life, including investing. Lots of people think, oh, I know better. I know what's going to go up. I know what's going to go down. I know what the economy holds, this, that, and the other thing. So, Taylor, talk a little bit about how you deal with the overconfidence bias.
Not something I suffer from in a financial view. I suffer from underconfidence, but I still want to hear.
Yeah, well, I think the good news is that a lot of people who are coming to us that are seeking financial help, they have had an experience where overconfidence has not helped them, or it has hurt them, or they've been managing it themselves, or they quote unquote knew what the market was going to do, or they knew that it was going to continue going up, or whatever, they knew it was going to go down. So they've had an experience based on overconfidence that has led them to our office. And honestly, that is a great place for folks to be, because they're seeking help, they're seeking counsel. And so a lot of times we're looking to serve folks that have had experience or on the other side of an overconfidence bias. Because when we are overconfident, it can be hard to take sound advice, hard to receive advice, and then actually adapt, change, and incorporate that into our reality. So a little bit different take on your question, but that's kind of what we see a lot.
One of the things that I see with overconfidence is not in the overconfidence in investing itself, but with a lot of people who have been successful in business or successful in a certain aspect of life. They have an overconfidence of what they know that seems to me to bleed into how you're going to invest. How does that play out, that type of confidence?
Yeah, I would love to jump in here, because that triggers a memory of mine. Some of the most challenging client relationships are those clients that are in industries where they have to forecast, right? So I've got a CFO for a company. He's got to forecast earnings. He's got to forecast hiring and decision making and borrowing. So he spends a lot of time studying economics and trying to make a forecast for his business, which is totally rational for his business to make a forecast for the short to intermediate term. But that leads to him having more confidence in his ability to forecast the market or the economic environment as it moves forward. And so I think you're absolutely correct. Confidence in one world can bleed in to a world where things are unknowable and unpredictable. But we think since we have an area of expertise or control in one area, it can create some overconfidence. Same thing happens all the time with employees who own too much of their company stock. Well, I know the management, I know our products, I know our services. Therefore, I know that this is a good stock. Well, academic research shows that all that stuff is just noisy and random, and it doesn't necessarily mean that you've got a good stock. A great business does not necessarily mean a good stock. So I think it bleeds into a lot of different areas, but I think your point's well taken about expertise in one area can bleed over to overconfidence in trying to understand and predict capital markets.
I'm not sure if this is part of the overconfidence bias, but one of the things I have picked up is that we as humans often need to come up with a rational story for events. So we often try and make sense of random events and try and explain them. Or we come up with cause and effect where none actually exists. And again, I think a sensitivity to that, those biases, is frankly probably helpful living your life. We're dealing with some very crazy events at the time we're doing this show, and there may not be an explanation, but other than stuff happens, as the bumper sticker says.
You're listening to Wealth Matters, the radio show where we discuss the opportunities and challenges of preserving and managing wealth. We are your hosts today, Craig Frankel and Robert Port from the fiduciary litigation law firm of Gaslowitz Frankel. And we're talking about behavioral finance with Jeff Benier, Andy Avera, and Taylor Stanfield.
Let's talk about another topic here that I find fascinating, but again, it's one of those things, once you read about it, it's sort of like an aha moment, and it's things that something called loss aversion. And the studies that I've seen have suggested that given our fear of loss, the loss of $1 is perhaps twice as visceral to someone as the gain of $1, even though the financial consequences, one up, one down. But the loss aversion or risk of loss and how that motivates decision making. Andy, do you want to deal with that again in the context of financial decisions? And I think that's particularly appropriate now as we are in a very volatile market. The market's up and down 1%, 2%, sometimes 3% a day or a week, and the fear and concern generated by that.
Yeah, I mean, there's certainly no question that the loss aversion is real. And, for clients, first, when we build investment portfolios for them, we try to build a solid foundation for them to prepare them for the ups and downs of the market. But I think for most individuals, when they see something go down, it's painful, right? I mean, the thought of losing money is painful and it paralyzes people. And so, you really want to have conversations with clients so they understand things go up and things go down, but you can't let the losses drive your decisions and let the emotions take over, because what will happen is it will force you into a position where you do make irrational decisions. And, we try to have conversations with clients so they understand what the feeling is like when you start to lose money, because the markets do go up and down. And so we try to prepare them for both sides.
Now, I've heard in your field, there's this concept called rules-based investing. Mm-hmm. Which you want to tackle that, because I think that's a segue from what Andy just said.
Well, I'll keep going. I do think, when we talk with clients about their investments, we want to have a plan out in the future that is not emotional, because it's easy for us to say, oh, we'll wait till that stock goes up 10% and then we'll sell it. Or if it goes down 5%, we'll sell it. But when you get in the moment, you're going to make different decisions. And so if we know 6 months from now, we've made a decision that we're going to invest over a monthly period, or we're going to do X, Y, or Z, that's rules based. It's easier in the moment to ignore the emotional side and try to make more rational decisions.
Okay, so how do you do that in today's environment where I assume your phone is lighting up every time the market drops? I'm still trying to explain to myself what a negative oil price is. I thought I'd go out and buy some oil and get paid for it. But how do you, when your clients really are understandably upset by the fear of loss, what do you do to bring them off the ledge?
So we bring them back to their goals. So everything we do is goals and values based. And so we talk about your portfolio's down 10%. Has anything changed with your goals and what you're trying to accomplish? And if the answer is no, we focus on the portfolio and we talk big buckets about bonds and stocks. And so the bonds have actually done well, reasonably well during this period. And so we talk about the war chest that we built within their portfolio to say, you have 10, 20, 30 years worth of expenses already built in your portfolio. The stock piece is the growth part. It's going to come back. And I don't like to throw a lot of data at my clients, but we do use past performance to show them what the markets have done historically, to show what happened for those who got out of the market in 2008, what happened to their portfolios. But we try to bring it all back to their goals and focus on them, because investments at the end of the day is just a tool to accomplish your goals.
Yeah, I would love to jump in here if that would be okay. I think what Robert was asking earlier about evolution, right? So as a species, we have survived because we reacted to the tiger in the bush, right? We fled, and that helped us survive as a species. If you're in New York City and you step off the curb and the crosstown bus is on the way, you jump back on the curb without even thinking about it. So in these kind of emotionally packed environments, the first thing you've got to do is recognize that you can't react emotionally. You've got to react rationally. And everything Andy just said is spot on in my view. Is you've got to go back and slow down, get the temperature down, and say, okay, what really has happened, and how does it affect your plan? Because studies have also showed that our IQ goes down about 13% in stressful situations. So the plan is the safety net. The plan is the seatbelt. So goal-focused and planning-driven. So the rules-based approach and the financial plan is part of those rules. Is, how do we, are we on track, not on track? Because I believe there's only two reasons to change your strategy. One is if you're no longer funded to your goals. You could be overfunded, you could be underfunded. Those would be legitimate times to change your strategy. The second is if it's affecting your health. Clearly, if it's affecting your health, you can't sleep, and there's a cost associated with ending that pain. But again, if it's affecting your health, you really don't have an option. So I believe that having a financial plan, having a rules-based approach that was thought out, evidence-based, because you really don't want to change strategy while the bullets are flying. The time to change strategy is we can just study the evidence and see, okay, what did we learn? But when bullets are flying, it's not the best environment to make dramatic changes if you set up your rules to begin with based on academic research and evidence that shows over time you've got a high probability of success.
Isn't that going to be a problem, though? I mean, most people, tend to only want to talk about finances when something recent happened. I think it's called recency bias, where what you're seeing is happening. That's when they're worried and want to think about their finances. But when things are kind of bouncing along, they don't. So how do you kind of invert the curve? You said it goes down 13% when you're stressed. I'm kind of curious when it goes up 13%. I've never seen that. So how do you avoid the fact that you tend to want to think, you are thinking about it when the bullets are flying? So Taylor, how do you get somebody to say, wait a second, this isn't a good time, or what you're looking at this week isn't forever.
Yeah, I mean, it has been exciting is probably not the right word, but it's been a great time to talk with clients, and we've had just great, real, honest conversations. And what's been great is that the people who have been listening and that have been seeking counsel and that have really wanted to implement a good rules-based long-term plan, yes, they want to talk, and they like you're saying, they're thinking about it, and they're asking questions. Do we make changes? What changes should we make? But if they've been implementing the plan for a long time, it's pretty easy to talk through that and go, you're in a great spot because we've been working for years on this long-term plan. And it's just been such a great opportunity to see that long-term planning is a great way to weather these short-term storms like we're having now. And so, but the folks on the other side that have not been we've been meeting for years, but they haven't been implementing kind of the plan that we've been talking about, it's harder to talk them off the ledge because they're not in a great place to sit back and let things kind of work itself out. And so those are the ones that I think are harder to have those conversations, talk them off the ledge. They're wanting to make changes faster, more drastic changes because they're not in the situation to take a deep breath and let the plan work itself out. So it's been a really, really neat opportunity to see that on both sides with folks, because it's like you're saying, it's bringing up thoughts of what should we do for everybody. Folks that have been implementing a good long-term plan, they're easy to talk down. The folks that aren't as much in a good position, it's a harder conversation.
And we've glossed over a little bit. All of you have used the word plan, and I think we've glossed over the fact that one of the services all of you and your industry that does it right provides is when someone comes to you, you understand their needs, you understand their risk tolerance, you try and understand their whether they can sleep at night, if the market goes down a little bit or a lot. And the plan you're talking about is developed as objectively as possible, but based on that criteria. Having done this work from the litigation side, what I often explain to folks is not everybody is, just like when you go to the store and buy a suit, not every suit is the same size and the same color. And the same thing for a financial plan. It's got to be tailored to you. And
every suit in my closet is in fact the same size and the same color, according to my wife.
That's what we get issued when we graduate from law school, a dark suit and a red tie, and they send us on our way. So I don't want our listeners to take away from this conversation that you're doing things on the fly. Clearly not. You're doing things impulsively. What the benefit of the services you provide is that you have set up a plan that is to weather that, both the ups and the downs. Yeah, you're listening to Wealth Matters Radio, the radio show where we discuss the opportunities and challenges of preserving and managing wealth. We are your hosts, Craig Frankel and Robert Port from the fiduciary litigation firm of Gaslowitz Frankel. We're talking with Jeff Bernier, President and Chief Investment Officer of TandemGrowth Financial Advisors, Andy Avra Wealth Advisors, and Taylor Stanfill, Verisale Partners. And our topic today is behavioral finance, tips for overcoming irrational financial decisions.
Andy, I want to go back to something you said earlier on about bias. Give some examples of some bias that you're seeing your clients have that may not automatically jump out at you or me.
Well, I think one of them is anchoring. I think, when it comes to whether they want to invest or not, they tend to anchor towards something. And so, I bought this stock at $100 and therefore it's worth more than $100.
So it's the Atlanta Coca-Cola syndrome.
It goes into stuff that, yes. So, there's anchoring, there's, there is that recency bias, and basically, the markets have gone down, I think they're going to continue to go down. Or, the markets have been doing really well, and I think they'll continue to do really well. And so, 2008 seems like, it was just yesterday that it happened. But I think the memory of 2008 has faded for a lot of people. And so, we've been in this long bull market, excluding the last couple months. But I think people just and realizing that there's a random element that's involved there.
And I think the concept of anchoring, the way I often think about it is people get fixated on a number or something that may or may not have any rationality to current events. For example, Andy just mentioned, 2008, 2009, real estate prices went down a lot. People were still anchored to the price their neighbor got for their house in 2006. And couldn't understand why their house was now being appraised, or if they tried to sell it, was maybe 30% less than that.
Yeah, I see this all the time. Let's say someone paid $100 for a security, and the security goes up to $200, and then the security falls back to $150. They'll say things like, "Well, I can't sell it because I've lost $50." And I said, well, if you sell it, I don't think the IRS is going to see it that way. You made a $50 gain. So you're correct. We tend to anchor on the highest price in terms of securities that we purchase. And, the stock doesn't care what you paid for it. It has a future income stream. You can discount those projected earnings and things like that to try to get a fair value for the stock, or whatever method you use to evaluate companies. But the stock doesn't care. The company has no, the market doesn't care when you got in or when you got out. So I think anchoring is a big one.
Taylor, what are some other examples of bias that you're seeing among your clients?
So I'm thinking a lot about, getting a little bit soft, like Jeff talked about earlier, is, we all have past experiences from childhood as we become adults, and some of those life experiences. For example, my parents filed for bankruptcy when I was a kid, and that I have so many things that kind of influence my behavior and beliefs, and that are biases for me because of some of those experiences. And so I see a lot of folks that are, their worldview, their financial view, their biases are shaped by their experience as a child, adult, work, from their career, from starting a business, from a business failing. There are so many things, and that, kind of go back to our conversation of getting to know clients, asking questions. It's understanding, okay, what has influenced your biases? What are those foundational elements that have built into those biases? To me, are just as important as kind of defining or terming them or naming them based on my experience.
One of the things that I've often thought about, and maybe this is self-revealing, but folks don't understand probability and risk.
Probably.
And the example often given is that, sort of like a Las Vegas example. If you flip a coin 5 times and it comes up heads 5 times, the probability that it'll come up heads again on the 6th flip is still 50-50. And I think a lot of folks, again, perhaps because some of our biases, some of our evolutionary tendencies, don't realize that, in my example, maybe you don't have a hot coin, maybe you don't have a hot hand. And any of you want to tackle how those kind of issues come into play in how you advise clients so they avoid irrational decision making?
Yeah, I think that what I have learned is that we're just not very good with probabilities. I agree with you. And again, because what happens is we tend to place a high probability on really salient things that are in the news. And just because something's easy to remember doesn't mean it was highly probable. And so I think all these kind of lead together. I saw a statistic once that a couple of years ago that more people died in one particular year from taking selfies than for shark attacks. And of course, everybody's afraid of shark attacks, but nobody's afraid of taking selfies. And I guess they were backing into traffic or fell off a cliff or something ridiculous. But the point is, when you hear the statistics about plane crashes, air travel is really safe. But when there is a plane crash, we are afraid to fly. The same happens with investments. So all these kind of lead together. And I think the storytelling, the narratives that you talked about before have something to do with this too. Because I think some of the behavioral biases I see lately is either fear of missing out. So, you've got these unicorn stocks going public and everybody thinks they want to jump on the IPO. Well, statistically, most IPOs underperform the market by about 21% over the subsequent 3 years. So statistically, IPOs are really bad investments, but we're afraid of missing out. And so when markets are going down, we always care about absolute returns. We don't want to lose money. When markets are going up, we care about relative returns. Did we beat the market? And both of them are irrational. So what really should matter is, your benchmark should be your financial plan and your goals. So again, I think this probability and risk, I think we naturally have a hard time dealing with that because it takes calories to think about probabilities. And so the stories are shortcuts. And so we just think shortcuts. And again, that served us well through evolution, but it's a bad way to make investment decisions.
Right. Sort of the visceral, immediate reaction.
Right.
What I've learned from my advisor is that if he has that reaction with respect to making a financial decision, he has tried to teach himself to step back.
Right.
Don't do anything, just because you have an immediate gut reaction to it. Even though in many areas of life, your gut reaction is often correct. This is one area where perhaps we ought to think about overruling that.
Right.
Robert, I think that's critically important and I think that's, again, it's part of our role as an advisor is to help people take a step back, and just think through, sleep on it, and just have that objective sounding board. Because a lot of times, just like you're saying, that initial reaction or thought or decision may not be the wise one.
And I will say, this goes back to, you talked about the plan. It's focusing on the long term, because that whole probability, well, the market went up 5% today. Surely it's going to go down tomorrow, or surely it's going to keep going up. And the markets are irrational. I mean, it's random. And no one really knows from day to day what's going to happen. And so you really have to focus on the long term.
And a perfect example of that, again, I'm talking about, this is something that happened recently. A week or two ago, employment numbers came out, X millions of people out of work. And my visceral reaction was, well, when I see the business news tonight, the market will be down X. Market was actually up. Yeah. And I'm reminded of a quote, I don't know if it was Warren Buffett or something like that, who said that the markets can be rational longer than you can remain solvent. And I think, again, what each of you bring to this is a plan to try and get beyond all that and follow a plan. Much like you used earlier, Jeff, the commentary about you don't make a plan when the bullets are flying. You might have to, but a good general, a good leader will have some plan in place and if necessary be able to change it.
So let's make some bullets fly. So explain to me maybe an example of actually, let me start to do it differently. Is there a different bias that you're observing between couples, whether they be same sex or more traditional, where one couple has one spouse has a certain view or bias and the other spouse has a different one? How do you play that out when you're talking to a client and trying to get them to invest as rationally as they can?
I'm happy to dive in there. That's something I love. I love kind of getting in a little bit of the messy and the weeds with couples. And it's usually that there's two different personalities. They're coming at it from two different angles, and like you said, two different sets of biases. And it can be a great experience when they can come together and use those different perspectives, the biases, and make that work for them. It can really bring them together. It can be a great experience. It can also be really tough if one or the other is not willing to lean in, give up some of their control or some of their thinking, and say, you know what, I see the world in red, you see the world in green. I'm okay giving up a little bit of my red view. That's required in order for them to accomplish all they can accomplish. And so it's really an incredible experience when they can do that, lean in, come together. But it also can be a really challenging experience if they're not willing to give up some of that control, give up some of their viewpoint, and say, you know what, you're right on this, and I can get better by leaning into your perspective.
Okay, Jeff, here's your big chance. We're getting towards the end of the show. Tell me the best example that you can recall recently where you were able to help a client overcome what you consider to be a pretty obvious bias.
Well, I mean, this happens all the time. Happened in 2008, 2009. It's happening today. And I'll just go back to Andy's recommendation about goal-focused, planning-driven. So, you have clients that are approaching retirement. You get a bear market in the intervening years close to the retirement date. You have a well-constructed plan that planned for a bear market every 5 to 7 years. I mean, we expect a bear market every 5 to 7 years, so it's already been expected in the plan, but it happens, and it's a big one like 2008, 2009. And the client will come in and say, I can never retire now because I've got a 30% downturn in my portfolio, and they look at the numbers. They don't look at the percentage. They always look at the raw dollars because it's a lot scarier, and it is. And so they come in and we say, okay, you're correct. Your portfolio is down a significant amount because you participated in some portion of the downturn. What do we do now? And the plan will help them see, you can retire, but you're going to have to spend 85% of the original goal. Or you could work 3 years longer and retire at the same goal. Or you could save more money over the next 3 years and retire at the same time with the same goal. And so it's really about coaching them on choices and trade-offs. So it takes a huge, scary thing and converts it into a 3-year problem or 85% of the original goal problem, or what do we do now problem, and it gives them some control over an action. Now, what normally happens is it relieves the pressure because they said, look, I thought I was never going to retire. It means I can retire in 3 years. I can retire at the same time with 85% of the income. So what ends up happening, they end up not upsetting a long-term strategic financial plan. And then as markets do what they normally do, within a year or 2 or 3 later, they're right back to where they were and they could meet their original goal because they didn't exit the roller coaster at the worst time. So really, I just take it back to planning. And that happens every day, it seems. So what I said before about you don't change the investment strategy when the bullets are flying, but you may change your plan when the bullets are flying because you have more control of your personal finances than you'll ever have on the capital markets. So let's deal with the things that we do have some control over. So anyway, that probably wasn't exactly the kind of thing you're looking for, but that happens every day, it seems to me, in client consultation, especially today.
Andy, do you have a bias, a client that's overcome a bias that you were able to help overcome a bias?
Well, I think the big one for me is that loss aversion. I have a lot of clients who, basically have a fear of running out of money, and it's, they could be worth tens of millions of dollars and spend very little of it. And so helping them get clarity as to what their long-term picture really looks like so they can make better decisions. And really, like, I enjoy helping people around philanthropy and charitable giving, and seeing someone who has a desire to give back begin to use some of their funds to give to charitable organizations has really been impactful for me. But taking to a place where they feel confident that they have enough and can give has been very rewarding for me.
Taylor, how about you? A bias that you kind of feel good about that one of your clients was able to overcome because you intervened?
Yeah. I think, the biggest one that's coming to mind consistently is just we're not going to be okay because of what's going on. I mean, in the midst of this pandemic, people are panicked and they're worried that we're not going to be okay, whatever that looks like, whatever that means for their situation. And so helping them, sitting down with them, virtually, looking at their plan, their cash flow, their net worth, and saying, you know what, we are going to be okay because of the work we've done over years. I think that's been the most clear example and rewarding, over recent weeks.
One of the things we hadn't mentioned, and it's perhaps too lengthy a discussion to get into here, is each of you have the capacity to do number crunching to demonstrate to your clients, at least we talked about probability of where they may end up. I'm thinking of things like a Monte Carlo simulation. So you're not just holding your finger up to the wind and saying, I think everything will be okay. You can, again, there are no guarantees. No one knows what the future holds. But given the software and computer programming we have now, you do have the tools to give yourself and your clients comfort that the plan you have come up with has a probability of success. No guarantees. So as we're getting close to closing our show, let me ask each of you to give our listeners your contact information, phone, website, email, whatever you prefer, to anyone who may want to contact you or learn more about your respective advisory practices. Andy, let's start with you.
Yeah, so you can go to our website. It's averawealthadvisors.com. It'll talk about our firm and who we are. You can also call me at 678-881-0813. And yeah, we just enjoy helping people. So happy to help in whatever capacity is beneficial.
Taylor?
Yeah, the best way to get a hold of us is verisail.com, verisail.com, and you can get all the info there.
Great. And Jeff?
Yeah, likewise. They can email me at jeff@tandemgrowth.com or on our website, www.tandemgrowth.com. And if you want to have a conversation, there's a little schedule a call and it'll go right to our schedule and we'll have an introductory chat over the phone. Thank you.
I want to thank all of our listeners for actually listening to Wealth Matters. And I want to thank all of our listeners for being somewhat patient as we go through our virtual radio show. I could observe there was a kink or two. Technically, I take all of the blame because we all know I'm in charge of it. But please accept our appreciation for your patience. And thank you for listening to Wealth Matters, where we discuss the opportunities and challenges of preserving and managing wealth. For information about Gaslowitz Frankel, please go to our website at gaslowitzfrankel.com. And remember to follow us on Twitter at Estate Dispute and use our show's hashtag Wealth Matters. Today's guests were Jeff Bernier with TandemGrowth Financial Advisors, Andy Avera with Avera Wealth Advisors, and Taylor Stanfill with Verisail Partners. Please join us every fourth Wednesday of the month at 8:30 a.m. here at Wealth Matters on Business RadioX.